Hey everybody, welcome to your weekend review for the week of Monday, October 10th, 2022. And oh, what a week it was. The week got off to a great start because the market was closed on Monday for Columbus Day and Indigenous Peoples Day, so I had the day off. So it was pretty darn good. Although I did read this juicy little tidbit that I wasn't aware of, and I'm glad I heard about. Pretty sure it came from robchrisman.com, pretty sure. But basically it's talking about I didn't realize that the water level on the Mississippi was abnormally low due to a lack of rain, and it's causing a backup of barges and different vessels trying to transport grain. This has led to a backup of 117 vessels and 2,000 barges. Each carries 1,750 tons of dry cargo, enough to fill 70 trucks, and a tow hauling 15 barges can move 900,000 bushels of grain. Not good. That's a lot of food sitting around, possibly rotting and not getting us to its destination. But the markets really opened on Thursday, and we had a very, very volatile day. UMBS 5.0 started off the day being 31 basis points down in early trading. Stocks were losing as well. UK bonds continued to sell off in the overnight, though the US yields only picked up about a third of the damage. Things are just crazy over there in the United Kingdom with their monetary policy. Throughout the day, it was nutty. So everything started out being down 31 basis points, but it actually fought all the way back to level par, or no change on the day, I guess I should say. Not all the way to par, that'd be a long ways, but back to no change on the day before tanking off again in the afternoon and ending up being down 55 basis points. Not only did we lose 31 basis points early, we picked up 31 basis points, then lost another 55. So that's a total of, in a day, about 150 basis points worth of movement in both directions, which is a lot of bouncing around and a lot of money moving. The mood is fragile ahead of Thursday's U.S. inflation data, with the case for another 75 basis point hike likely coming. Everything is pointing towards the 0.75 increase. Fed officials until now show little sign that they're in the mood to pause this rate hiking cycle. Everything with jobs seems to be supporting it. Third quarter earnings season kicks off this week with the big banks all reporting later on this week. Today in pre-market trading, Meta Platforms, otherwise known as Facebook, dropped with other big tech names sensitive to rising rates. The dollar erased a gain that had taken it to its highest this month. The retreat from U.S. bonds appears to be also picking up pace as the Fed speeds up its plan to sell treasuries off of its balance sheet. So if they start doing that now, it's going to get real ugly. Tomorrow is a 10-year bond auction on Wednesday, and an hour later we get the Fed minutes from the last FOMC meeting. Next morning we get CPI data. One of the problems there is that we're replacing a really low number from last year, so it's definitely going to rise. Although small business optimism index increased slightly in September, wages did moderate while those that expect higher selling prices fell. MBS are trading in a wide range, and it was bouncing all over it today. So we ended up the day at 96.58. We are bouncing around in a wide range with a floor at 96.281 and a ceiling of 98.297. Hopefully we can stay above that floor. Also saw an article today from Fortune magazine that says a 2007 flashback. Home flippers are in trouble again. Let's not make every single housing-related story something that's bad about housing. Yeah, if people bought houses at the top of the market and then wanted to put 150 grand in it and flip it and make a profit, that's a bad decision, not just weakness in the housing market. Let's not get things twisted as these news stories are coming in over time. And Wednesday the 12th turned out to be a fairly mild-mannered day on the markets, all things considered of what we've seen recently. Early in the morning, the MBS were down 12 basis points and stocks were up 12 points. As the day went on, we got some PPI information, producer price index, which rose 0.4%, which was in line with expectations. Year-over-year core rate decreased from 7.3 to 7.2, slightly below expectations. Final demand rose 8.5% year over year off of an estimate of 8.4. So not enough to translate into progress, but not terrible. So pretty much in line with what was expected and baked into the market. At the end of the day, we ended up being up 8 basis points on the MBS 5%. Stocks ended up being down 12 points. So money came out of the stocks and into the bonds as the day went along. We also got a 10-year Treasury auction that came in at a 3.93 rate versus a 3.916 at 1 p.m. when issued. The bid to cover was 2.34 versus a 2.42 recent average. Not too shabby, not great, not catastrophically weak, but also not strong either. We also had some analysis of some comments by Fed President Loretta Mester, who spoke on Tuesday, saying that she hadn't seen any progress on inflation and that they needed to keep raising aggressively. Though this is from somebody that's been kind of off track, you can see here that all of last year she was not on point when it comes to predictions of inflation, even saying that it needed to be higher. Yeah, good job, Loretta. Got your wish on that one. Thanks. But all in all, yeah, we ended up the day at 96.66, which was right in the middle of that range where we're bordered by a 98.297 ceiling and a 96.281 floor. But at least we were headed in the right direction towards the end of the day. We also got some industry news with Finance of America has announced it will stop funding or purchasing correspondent loans through its forward wholesale or non-delegated correspondent channels next month. It also ended its discussions to sell its retail division to guaranteed rate. So we'll have to see where Finance of America goes from here. And we also got a post from our sponsor at WellThatMakesSense.com. It's one of our final posts on the book, Innovator's Dilemma, where it says, when there is a performance oversupply, it creates an opportunity for disruptive technologies to attack from below. The intersection of performance supply and performance demand is a critical juncture in a product lifestyle. Performance oversupply was a concept I was not familiar with. This is where the products provided far exceed the needs of the consumer. And when they keep doing that, it creates an opportunity for people to come in and create new opportunities with disruptive technology. So if you want to make sure that isn't happening in your company, check out our blog at www.wellthatmakessense.com. And then Thursday came around, and what a crazy, wild roller coaster of a day it was. It was a good thing that we were talking to people about locking into the CPI reading, because we got it, it sucked, and the market reaction sucked. The CPI index rose 0.4% month over month and 8.2% year over year. The month-to-month number was double the expectation of 0.02. Excluding food and energy, it rose 0.6 month over month, which is 6.6% year over year. The market expected 0.5 on that one. Gasoline declined and food continued to rise, although OPEC has already solved that first problem because they announced last week they are going to cut production by 2 million barrels a day. So gasoline prices will be going back up. Shelter increased as well and continued to increase as it tends to lag home prices by about 18 months or so. The completely inadequate measure of housing rose 0.7%, which is actually still the highest since 1991. A Realtor.com report, which is more timely, showed that rental growth slowed to 7.8% year over year, which is still pretty high. So far, we aren't seeing anything that looks like a deceleration in the core rate of CPI. We will not get another CPI reading before the Fed meets in November. The FOMC is November 1st and 2nd. So this is the last reading that they'll be using as data. Fed minutes were mostly hawkish, meaning that they're predicting more increases. Sentiment was that more increases are needed even before this CPI reading. The Fed futures are locked in at least a 75 basis point hike, with a lot of people beginning to handicap a full 100 basis point hike as a possibility. The number of Americans filing for new claims of unemployment rose 9,000 to a 6-week high of 228,000, which was higher than the expectations of 225,000. That was all in all a pretty low number. The day was crazy. Like we said early in the morning, they were off a lot. We were down a point early on in the day before fighting back to end up the day only being down 9 basis points on the day. But as you can see, that is actually a 97 basis point improvement versus earlier in the day. So it came fighting all the way back to get back into that range we've been watching all week, with a ceiling of 98.297 and a floor of 96.281. Great commentary from Rob Chrisman today, where it's asking, why aren't we seeing prices of 103 on our rate sheets? Why aren't we seeing more premium in Optimal Blue and on our rate sheets? And it's because the 30-year mortgage rates firmly in the 7% range has moved too fast for any kind of substantive premiums for lenders. So basically everything's gone up so fast that lenders and investors haven't had a time to figure out how to price everything in correctly. Put another way, there aren't any securities trading at prices like 101 or 103 that offer par pricing that can be passed along, and the volumes continue to decline. So there aren't enough loans to make these pools, and there aren't enough people wanting to buy them. So there's a mismatch in that. As one fellow capital markets vet wrote to him, I don't see premium pricing in the capital market. So the raw rate sheets aren't even showing premium pricing. So you can't really give it on to your loan officers, especially after you factor in FICO hits or second home hits or investment properties and all of that stuff, plus comp and margin. With high bond coupons trading right on top of each other, essentially meaning that, 5.5, 6, 6.5, 7 are all basically right the same price. You can't really get any premium. You can also note that correspondent investors can and will cap your execution price. So while you could originate a 7.75 rate, they can't provide a pricing for it because there's no one to pick up the 7.625 or the 7.25 bonds. There just aren't enough of them. There aren't enough people wanting to buy them. Also got an interesting chunk of information that has nothing to do with the mortgage world, but it's interesting about the world in general. So apparently scientists have taken clumps of human neurons and implanted in the brains of newborn rats and have successfully integrated these clumps of human neurons into the brain chemistry and circuitry of these rats. This procedure is expected to shed light on psychiatric disorders like autism by illuminating how genetic mutations influence neural circuits, which is some crazy stuff. We also got another post, which is one of the final ones, on the innovator's dilemma. A big mistake the managers make when dealing with new technologies is that they try to fight or overcome the principles of these new technologies. It's more important to understand what's driving them, because disruptive technologies change the value proposition of the market, and if you're not paying attention, you can't see that change coming. And we had kind of a weird reaction to all the news and data on Friday. In the morning when I woke up, bonds were only down like 3 basis points when I got started, but by the time I got done writing my morning post, they were already down 16 basis points. Not a lot of fun there. They basically trickled around and went down all day, ending up today being down 33 basis points as a whole. We're now looking at the MBS 5.5 coupon because rates have gone up and there's finally some liquidity in that 5.5 coupon. So they are right in the middle of a pretty big range, bordered by a ceiling of 99.54 and a floor of 96.984. Right in the middle of that wide range, which is going to lead to a lot of bouncing around. The news of the day. Bonds had a good overnight session with fairly steady gains in both Asia and Europe. Kwarteng, the British finance minister who kicked off the worst of the recent rate drama 3 weeks ago today, resigned. But the British prime minister has made several comments to leave doubt that anything will really change as a result of that pretty much he was following orders. No real reaction to the retail sales numbers this morning, at least not right away. It might have been a bit of a delayed response. Retail sales came in flat versus a plus 0.2 forecast. It was 0.4 previously, so things are slowing down and people aren't buying as much. Excluding autos, gas, and building materials, it came in at plus 0.4 on a plus 0.3 forecast. It was 0.2 last month, was revised up from flat. Consumer sentiment came in at 59.8 on a 59 forecast. It was 58.6 previously. People got more optimistic, huh? Interesting. Current conditions was 65.3 versus 59.9. Okay. And the 1-year inflation expectations came in at 5.1 versus 4.7 previously. The Fed futures have a 96% chance of a 0.75 point hike the next time around and a 0% chance of 50 basis points. So at the end of the day, we ended up in that wide range. We also got some other news. Home Point Financial cut its credit lines. They closed a credit facilities. They terminated their master repurchase agreement and securities contract with Credit Suisse, First Boston, and Morgan Stanley. JP Morgan Chase came in with better than expected earnings this morning as third quarter earnings season begins. Mortgage volume was down 45% on a quarter-over-quarter basis to $12 billion. A year ago, the company did $41.6 billion in the third quarter. Oof, that's a lot. Overall revenues rose 6% quarter over quarter and 10% year over year, while earnings per share increased 13%. Wells reported weaker than expected numbers. However, there are some special items, litigation, that are making comparisons difficult. Q3 mortgage volume came in at 21.5, which is down 37% quarter over quarter. Though, if you remember, they had some pretty big announcements of scaling back their mortgages. Despite the miss, 5%. Despite the miss, Wells was up 5% pre-open on the day. Next week is a fairly quiet week news-wise. We do get a 20-year bond auction on Wednesday. There's also going to be gasoline inventories, which gas is a big issue right now. You're going to get some housing starts and building permits, though those haven't moved the bond market that much recently. We have on Thursday, we have the Philly Fed Business Index as well as jobless claims, and then a 5-year note auction, as well as some existing home sales and things like that. So not a lot of news coming next week, but we don't need financial news. But we don't need financial news to move the market. Plain old news stories do fine on their own. So hopefully everybody has a great weekend and gets to chill out a little bit. It was a tiring one. I am going to take a nap after editing this. Hopefully you also have some time to check out some of our common sources and influences, and I hope you have a great weekend.